In this video, I'll walk you through each of these three sets of journal entries that are required to journalize the issuance of common stock that is sold on these two dates. So what I'm going to do here is kind of visualize everything for you so you can see what's actually going on. I think it's very important. So you'll see on this sheet I've got stuff all over the place, and we'll walk through it here. But I want to always have your mind thinking about whenever there's a transaction that changes the economic situation of the organization, the goal of the accountant is to reflect that change in economic stance on the financial statements. It's our whole reason for existence. So we're focusing in on the balance sheet here because that's what this chapter focuses on, is the equity section of the balance sheet. And you know that on a balance sheet consists of assets, liabilities, and equity, and on the left side we have the assets, and they have to equal what happens on the right side to the equity and to the liabilities. So we'll have this in mind as we walk through each of these transactions. So what we know is that the organization issued shares of common stock on two separate dates during the year, and I have it kind of summarized here for us. They issued 30,000 shares on January 10th and 60,000 shares on July 7th. Now one was issued for $5 and one was issued for $7, and that's to reflect the market price. The market price of stock fluctuates daily based on the changes of the economy and the economic variables that come into play when shareholders look at the value of an organization. So it's not unlikely for the share to jump in $2 in price in 6 months. It happens all the time. It could go back down or vice versa. So when I look at issuing stock, we have two sides of this transaction. We have the shareholders are going to take part in the transaction, and the corporation is also taking part in the transaction. Remember, we are going to journalize and record financial statements on behalf of the organization, the corporation, and not the shareholders. So we're interested what happens to their financial records. And in this case, in this transaction, the shareholders over here are giving cash, pushing a wheelbarrow of cash over to the company and giving it to them. And in exchange, the organization is saying, okay, well, you give us that cash, we give you something in return, and we give you shares of stock, common stock, and that's represented by these stock certificates here. So that, in essence, is the transaction. Our goal is to get it into the into the account so that it's reflected correctly on the financial statements on the balance sheet. So I have down here for us listed each of the three accounts that could possibly be affected whenever common stock is issued for cash. So if we're getting cash, our cash is logically going to increase, or the company, and the equity that we have issued, the amount of ownership we have in the organization, increases as well. So common stock is equity, that's this side of the balance sheet, goes up, and paid in capital in excess of par, which is also equity. These two combine into the equity account. They both represent the ownership interest of the organization. They increase. So now we need to figure out by how much do each of these accounts increase. So the journal entry will look something like this. We have the date, which is January 1st of 2010. Or January 10th, I should say. We're not told what the year is. We receive cash. Our cash increases by the amount received, which is 30,000 shares, number of shares, times the market price, $150,000. Now the left side doesn't equal the right side, so we have to even this out. So the equity needs to go up logically by $150,000, but you don't just throw it into this bland account called equity. You increase both the common stock and the paid in capital in excess of par account based on the par value or the stated value of the stock. And here we're told in number 1, the par value of the stock is $5. What this means is that we take the number of shares issued, 30,000, times the par value of $5, and we push that into the common stock account. The par value matches the market value, therefore the amount pushed into the common stock account is the same as the cash received. We should also journalize then the second entry, where on July 7th we receive a pile of cash, in the amount of 60,000 shares, number of shares times the market price per share of $7, $420,000. And we put some of that into the common stock. The amount that goes into the common stock account, the amount of ownership we've just issued, is the number of shares, 60,000 shares. But watch this, it's not times the $7 because the $7 is not equal to the par stated value. You only put into the common stock account the value of the par value or stated value times the number of shares. So 60,000 times 5. The difference goes into this paid in capital in excess of par. It's for 120,000. So now my debits equal my credits. That's all good. This is my asset side of the balance sheet. Assets go up by 420. Equity also increases by 420 because both of these accounts are equity accounts. So that's how you journalize this transaction if the par value is $5. Now let's pretend that the par value is $1, not $5. How does that change this transaction? What I can do here is just copy part of this down. We're still going to receive the same $150,000 in cash. That doesn't change, simply because we have a stated value of $1, not a par value of $1. You take and push into the common stock account. Remember what we said before was the number of shares issued, 30,000. So 30,000 shares times this par stated value. Remember, par value and stated value are really an archaic term. They had meaning way back before our financial markets were regulated, and it just meant that an organization couldn't issue stock at below the par stated value. These days, lots of companies issue stock without a par stated value, but the accounting for these transactions really depends on the par stated value because it's really a formal legal transaction that we need to get into the accounts in the appropriate records. So you'll notice that debits don't equal credits. The paid in capital in excess of par increases by the difference because it's the amount of cash we received minus the common stock, $120,000. So if we move to the July 7th transaction, we're still going to get that same amount of cash, 60,000 shares times $7 or $420,000. The amount that goes into the common stock account is the number of shares issued, which was 60,000 times the par stated value of $1. And remember, the difference goes to the paid in capital in excess of par account. Now third, if the stock has no par and no stated value, what do? I'm just going to copy these down quick. It has neither a par or a stated value. So logically, it's not possible to have stock issued greater than par value or stock issued greater than stated value because there is no stated and no par value. So it's not possible to have anything into the account called paid in capital in excess of par or paid in capital in excess of stated value because it doesn't exist. And actually, while I'm thinking of it, you probably should change the terminology to paid in capital in excess of stated value instead of par, because in this case there was a dollar stated value, not a par value. Really a technicality here. But in this case, we go back here, we still receive the same $150,000, but the entire amount goes to common stock. The second transaction, we received $420,000. And the entire amount goes into common stock. So this is at the account level, right? The journal entries get entered. They would get, if we follow the accounting cycle, these entries would get posted to the appropriate accounts, and these accounts would get closed out at the end of the accounting period into the balance sheet. And since the accounts balance, the transactions balance, we know that our balance sheet will balance. And we'll have the right amount in the asset section and the right amount in the equity section. So just remember that there is a difference, a significant difference in how you account for issuance of common stock if it has a par value, stated value, or neither a par nor a stated value.